Imagine this. You've been paying your insurance premiums for years without fail. Disaster strikes, and when you finally file a claim, it's denied. You're left with nothing but excuses from your insurer. Why is this happening to more and more people? The answer might be more frustrating than you think. The illusion of protection. Why claims keep getting denied? You've paid your premiums every month, every year, expecting that when life throws you a curveball, your insurance will catch it. That's the promise, right? But for countless policyholders, the reality looks very different. Imagine needing a critical surgery or waking up to a flooded home, only to be told your claim won't be covered. What's happening here? Why is the system designed to leave so many people hanging at their worst moments? Insurance is sold as a solution to our deepest fears. Health emergencies, car accidents, natural disasters. These policies are pitched as a safeguard, ensuring you're never left without help when you need it most. The marketing is powerful. It taps into basic human desire for security. Yet, the confidence you've been sold can come crashing down once your claim crosses the desk of your insurance company. According to a 2023 report, private health insurers denied about 14% of all submitted claims. That means if you filed 7 claims last year, odds are at least one would have been flat out denied. For plans sold on the ACA marketplace, the numbers are even worse. 1 in 5 claims were denied. That's 20%. Now, companies argue that many of these denials are based on fraud prevention or incorrect filings, but critics point to something else. Often it comes down to the fine print in your policy, the language most people never review until it's too late. Take this example. A woman battling cancer was prescribed a life-saving treatment by her doctor. Her insurance denied the claim, calling the drug experimental, even though it had already been FDA approved. She waited 9 months and had to appeal 3 separate times before the decision was finally overturned. By then, her condition had deteriorated. Vague wording, like medically unnecessary or not covered under standard guidelines, leaves patients and policyholders in the lurch. These phrases give companies enough wiggle room to reject claims without clearly violating the terms of the contract. This process isn't random. Insurance companies increasingly rely on algorithms and pre-authorization technologies to manage claims. These systems analyze your file before a human even sees it, flagging anything insurers consider high risk or costly. For the companies, it's cost control. For people like you, it's a roadblock that stands between what you thought you were paying for and the help you actually receive. Here's where it gets even more frustrating. Many people never fight back. A Kaiser Family Foundation study found that less than 0.1% of claim denials from a 2022 dataset were appealed. Of those that were, about 40% were overturned in favor of the policyholder. Let that sink in. Most claims that are challenged stand a solid chance of being approved. So, why don't more people appeal? Experts blame a lack of awareness. The average person doesn't know their rights or assumes the initial no is the end of the line. The core question isn't whether or not denials happen. They do. The bigger issue is why so many of those denials are successful. Are the rules intentionally complicated? Does the vague language exist solely for legal flexibility? Or is it just a numbers game, a system designed to wear you down until you give up and move on? Here's the catch. Even if you manage to appeal and win, many Americans are still facing a different kind of pressure. Rising premiums. That's right. While denied claims leave some footing the bill they hoped insurance would cover, premiums are hiking up every year, squeezing customers before they ever even file a claim. Who's really winning here? And more importantly, what's fueling this cycle? Why your premiums keep skyrocketing, even if you never file a claim. You haven't filed a claim in years, maybe ever, but somehow, your insurance premiums keep climbing. It's frustrating, right? You followed the rules, avoided risks, and done everything to keep costs low. Yet your bill seems to grow bigger every time it shows up. So what's really driving these relentless hikes, and why does it feel like there's no way around them? Let's start with the big picture. Over the last few years, insurance premiums have risen at a pace that far outstrips inflation. Homeowners insurance alone saw a 40.4% increase over the past 6 years. The steepest spikes? They've occurred in just the last 2 years, with rates jumping 11% in 2023 and another 11.4% in 2024. Today, the average cost of homeowners insurance in the US is $2,801 per year. And while it's clear these rising premiums are adding strain to household budgets, the reasons behind them depend on who you ask. Insurers often point to external factors like the increasing frequency of climate disasters. Hurricanes, floods, and wildfires have wreaked havoc on homes across the country, driving up claims and repair costs. If you live somewhere considered to be a high-risk zone, you've likely been hit the hardest. A U.S. Department of the Treasury study found that homeowners in areas with the highest climate risk paid an average of $2,321 in premiums between 2018 and 2022. That's 82% more than those in low-risk zip codes. But these hikes aren't just affecting people in disaster-prone states. Utah, for example, saw premiums jump 59% from 2021 to 2024, even though the state isn't widely associated with major climate events. Similarly, Illinois premiums rose 50%, with Arizona and Pennsylvania not far behind at 48% and 44%, respectively. Companies also blame rising home values and replacement cost. As the cost of building materials and labor increase, the price of repairing or rebuilding a home climbs too, and insurance companies are adjusting their premiums to reflect that. In theory, this makes sense. But there's another side to the story, one that raises bigger questions about how fair these increases actually are. Yes, disasters and property values play a part, but they don't tell the whole story. For instance, fraud, both large-scale schemes and small individual cases, is often used as a reason for higher rates. Insurance companies pass these costs on to customers, citing the need to stay profitable in the face of rising claims. But at the same time, insurers are padding their profit margins. A look at industry earnings shows that many companies have maintained or even increased profitability, even while claiming premium hikes are necessary for survival. This brings us to another uncomfortable reality. Premium increases aren't distributed equally. Families in Louisiana, for example, are projected to experience a 28% jump in homeowners insurance costs, the largest hike in the country. And while coastal states understandably face higher rates due to hurricane risks, places like Iowa and Minnesota, which are far less likely to face major climate events, are still seeing double-digit increases. It leaves many wondering whether these discrepancies are tied to real-world risks or to insurers' strategies for maximizing revenue. And here's the thing, even if you live in a low-risk area, you might feel like you're subsidizing the risks elsewhere. Over the last 3 years alone, homeowners across the country paid an additional $21 billion in insurance premiums. That's a staggering increase by any standard, and one that's affecting people regardless of how much risk they actually face. So where does that leave us? Climate change, fraud, rising home values. These are undeniable factors, no doubt about it. But they don't fully explain why premiums are climbing so quickly, or why the burden feels so unevenly distributed. Is it just a necessary response to rising costs, or does it reflect a system designed to prioritize corporate profits over fairness? And how much of the money we're paying now is actually going toward future coverage? And how much is getting absorbed into the system itself? What makes it harder to swallow is this. Even as consumers bear the brunt of premium hikes, there's another layer of financial manipulation at work. Fraud doesn't just happen at the consumer level. It's baked into the system in ways you might not expect, and in some cases, it's costing you even more. Fraud and loopholes, the dark side of the insurance industry. What if the biggest threat to the insurance system isn't fraud from individuals or outside factors, but the system itself? Sure, we hear about people staging car accidents or insurance scams harming companies, but the truth is, massive fraud often originates from within the industry or by those exploiting loopholes embedded in its structure. And the cost of these scandals? It lands squarely on everyday consumers who face rising premiums or denied claims as a result. Let's start with an eye-opening case. Operation Gold Rush. This wasn't just a few crooked individuals. It was the largest healthcare fraud case ever charged by the Department of Justice as part of the 2025 Healthcare Fraud Takedown. 11 people based in multiple countries pulled off a scheme that targeted Medicare and bilked the US government out of over $10.6 billion. They didn't do it through simple scams, though. They bought up durable medical equipment companies and used them to submit endless fake claims, relying on stolen identities from more than 1 million Americans. Think about that. Entire businesses were operated solely to feed into this fraud machine. But it doesn't stop there. Once the money rolled in, they used shell companies and international banking networks to bury the funds. These weren't one-off transfers either. Billions of dollars were funneled through countries like China, Turkey, and Israel, as well as cryptocurrency platforms, making it almost impossible to trace the money trail in real time. It took years for US officials to piece this together. And while they eventually seized $245 million in cash, cars, and crypto, that's just a fraction of the total losses. Here's the kicker. While this massive fraud unfolded, taxpayers were footing the bill, and Medicare users were left dealing with increasing costs for coverage they rely on. Fraud like this demonstrates how the system can be manipulated from the inside. But even legal policies have their own built-in risks for consumers. Take life insurance, for example. Most people assume it provides a financial safety net for their families, no matter what. But policies often contain tricky clauses that undermine this promise. One big one is the contestability period. If the insured person dies within the first 2 years of a policy, the company can investigate and deny the claim entirely if there's evidence of an error on the application. Even something as small as misstated weight or a missed prescription history. Similarly, the suicide clause prevents payouts if a policyholder takes their life within a specific time frame, leaving grieving families without the financial support they expected. And as more loopholes like these come to light, it's clear that the benefits policyholders think they're paying for can sometimes seem more like a suggestion than a guarantee. Another example. Insurance companies often rely on extensive algorithms to identify claims they think might not hold up under scrutiny, cherry-picking which ones to deny. A 2025 study by Carpe Data revealed that traditional fraud detection methods only analyze 5% of open claims. And even within that small pool, nearly 8% of cases contain fraudulent elements. Insurance companies may not notice until months or even years later. On one hand, catching fraud is necessary to maintain trust in the system. On the other hand, the constant suspicion leads to delays and denials for policyholders with legitimate claims. If this all seems overwhelming, you're not alone in feeling that way. How do you protect yourself when the system is riddled with fraud, loopholes, and questionable practices? The good news is that proactive tools like machine learning are now being used to expose large-scale schemes before they grow. For example, advanced fraud detection software has already flagged billions of dollars in suspicious transactions. That's helping law enforcement crack down on schemes like Operation Gold Rush faster than ever before. But for individual consumers, the responsibility to stay informed is still critical. Knowing the fine print of your policy, or challenging a denial when something doesn't add up, can make all the difference. Still, it's hard to trust a system when these issues are so widespread. Is there a better way forward? And how can you avoid some of these pitfalls altogether without becoming an expert in policy law? Insurance was created to protect people from life's biggest risks. But for many, it feels like navigating a maze designed to work against them. The rules, the systems, and even the fine print can make it hard to know what you're actually paying for. That's why awareness and vigilance are your best tools. By understanding what's in your policy, key terms like pre-existing conditions or accidental damage, you can better protect yourself. Ask questions, dig into confusing clauses, and when necessary, challenge denials. In future videos, we'll explore alternatives, like new insurance models, and success stories from those fighting back against the system.